This is video lecture 1-5, which is the last video in our first topic, basic bookkeeping, and this deals now with the closing process. The closing process is the end of the accounting cycle, where we do two things. We close out the temporary accounts to update the balance in retained earnings, and we prepare for the next accounting period. We need to get our temporary accounts all back down to zero. So let's take a look at our closing process. When we talk about temporary accounts, we are talking about revenue expense accounts and our dividend account if it is used. The example in the textbook, if you remember, takes a dividend declaration and applies it directly to retained earnings without the use of a dividend account. If a dividend account is used, it of course is a temporary account that is part of the closing process. If it is not used, then we will simply be closing revenue and expenses. We'll be doing this to an account that is called Income Summary. This is a temporary account that lives only in the closing process. It will be closed out prior to us going on to the next year. Our permanent accounts, of course, are our liability accounts, our asset accounts, and shareholders' equity. Income summary is closed out to retained earnings, which is then transferred over to the shareholders' equity as the new balance that will be reported on the balance sheet. All right, so since we did not use a dividend account, the closing process will take 3 steps. We will close the revenue accounts to income summary. We will close the expense accounts to income summary, and then we will close income summary to retained earnings. If there had been a dividend account, we would more than likely include it in the closing of the expense accounts, since it also carries a normal debit balance. So again, in this example, this is our adjusted trial balance from the textbook example. Again, call your attention to the fact that prior to the closing process, retained earnings has a beginning balance of a debit of $1,000, and this represents a dividend that was paid during the period. This is a new company, so it did not have a prior retained earnings balance. The first thing we're going to do is close out our revenue accounts. Here we have 2 accounts, an operating revenue account, sales revenue, and we have rent revenue from subleasing some of our space. Both of these revenue accounts carry a credit balance, so to bring their balances down to 0, we debit their account by the balance prior to closing. The total of those debits will be a credit to our income summary. So now, after this entry is posted, our 2 temporary revenue accounts will have a balance of 0. They're ready to go for the next year. And we have credited income summary by the total of the 2 balances. Next, we're going to close out our expense accounts. The total of these accounts is $36,333. We're going to be crediting each of those temporary expense accounts for their balance amount, and the total of these credits will be our debit to income summary. So again, by doing this, all of the balances after the closing process for our temporary accounts will be zero. That means they're ready to go for next year. And we will then debit income summary for the total of our temporary account balances. And now income summary has a credit balance of 2417, and that represents net income for the period. So our retained earnings balance will be increased by the amount of net income. In this example, the dividend was directly debited to retained earnings. So we will be increasing the retained earnings balance from a debit amount of 1,000, and we'll be including this net income, and we'll be bringing down the balance of the income summary account, our temporary account, to zero. So now our retained earnings balance, which began prior to the closing process with a debit balance of 1,000, we add in net income, and our new ending retained earnings balance of 1417 is what's reported on the balance sheet, and income summary at the end of this process has a balance of zero. The final document we'll prepare is the post-closing trial balance. It lists all the permanent accounts for every account on the statement other than retained earnings. We will be using the amount that was on the unadjusted trial balance, but on this statement now we will update retained earnings to its new balance of 1417, and all of our temporary accounts have been removed from the post-closing trial balance. In class, we're going to be looking at this exercise where we'll prepare the financial statements, and then we'll go about and prepare the closing entries at the end of the year. This concludes topic 1. Hopefully these videos will refresh your understanding of basic bookkeeping.